You know, it almost seems a little bit like a time warp to talk about something you did 15 years ago. The world has changed a lot since then. It's an internet world today. We have DVDs, which we didn't have back in 1987 when we did this little presentation. At that time I had 2 books out. Now got out 12 and working on a 13th one. And I think we're getting into some more exciting territory as well. One of the big changes between then and now is the development of the socionomics area, and that is taking basically what we were teaching back at that time but putting a more philosophic spin on it and essentially saying it's more important than people think. What's really going on is that the social mood that's making the stock market fluctuate up and down is also causing people to do all sorts of other things. It comes out in social actions, and we're certainly seeing a lot of very dramatic social actions today, and I think they've resulted from the trends that have been in place in recent years. The stock market has probably finished its great wave 5 from the 1974 low and even from the 1932 low. That's certainly something that we couldn't have said back in 1987 when we were doing this video. This was our 5th major seminar. We had already had 4 of them under our belt. You can tell, I think, that it's pretty polished at this point. We put a lot of effort into designing it in the first place, but doing it a few times really helps. I don't think there's a wasted minute on this thing. I think the quality of information is still the best that you can get anywhere. There have probably been 1 or 2 books written since then and a few people offering tutorials, but nothing new. Let's face it, R.N. Elliott was a genius to have discovered what he did, to have discerned the patterns that are in the stock market. And as yet, we haven't had anybody come along and say, well, here's some nuances, and if you really apply yourself, you can see that the market's got an extra pattern or maybe doing something different from what Elliott said. So genius like that comes very rarely, and I think we're fortunate that we can teach something that a man like that discovered back in the era before computers, before the internet, and before DVD. It may surprise you to know that a small company like ours at the time spent $100,000 just producing this video. We had a real-time truck outside. We had 3 different cameras in the room. We had all kinds of personnel involved in producing this thing. And there was a lot of post-production because we didn't want to have, you know, extra time-wasting stuff on these videos. We wanted to make sure that every minute counted. And I think when you see it, you'll see that it does. And to bring it back to the beginning, I think that one of the wonderful things we have today is DVD technology, because that allows us to show off all the hard work we did back in 1987 and bring this series of seminars to you on a format that's fun, easy, and shows off all the good quality that's there. Welcome. This, to a great degree, I think is an historic event. The last time there was a series of Elliott Wave seminars was 20 years ago in Chicago. This wraps up our series in Atlanta. It's our 5th one in 2 years, so I'm glad you could make it. I think, in fact, you probably are among the most fortunate group because we've actually added 1 or 2 items during the 2 years, so we're going to cover absolutely everything we can tell you about the wave principle. Did anybody hear the alarm go off a little while ago? It was really loud. Lou Rukeyser tried to get in through the back door. I think we're going to have a lot of fun over the next 2 days. Now, does everyone have this workbook? Make sure you've got it. If you don't, raise your hand and someone will take care of you. Good. I want to stress one thing. We didn't call it a manual, so it is not full of all the information you need to know. This is a workbook. It's something for you to write on, to take notes on, to work with. When you combine it with the Elliott Wave Principle book and the Precision Ratio Compass Manual, that combination will give you all the information you need. We've got a lot of information to cover in just a couple of hours, so I want to get straight to work. The most important thing to realize at the very beginning of any study about the market is not, at least right away, what methods you should be following, but what approaches you should not be following. Those approaches are the ones that the crowd is paying attention to, and the crowd is usually wrong. The most important area of information to ignore is the daily news. It's meant to throw you off. The other important area involves the popular points of focus on data outside the market, which are assumed to impact the market. Does anyone here not remember the incredible hand-wringing that people used to go through a couple of years ago over the weekly money supply figures as reported? People would wait with bated breath. They'd be afraid to be in a futures contract because that money supply figure was coming out. It got to be such an intense focus that they switched the reporting time from Friday after the close to Thursday after the close because people couldn't stand going all weekend knowing that the market was going to open way up or down on Monday. Well, it took a while, but eventually people realized that that money supply figure, as crucial as they were convinced it was for so many months, actually had very little to do with where the market would be the next day, the next week, the next month, or certainly the next year. There was also a period in 1985 and 1986 when it was observed that every single movement in the stock market was preceded by a movement in the bond market. So people began to focus very closely on every single move in the bond market. Every little tick it was making, literally, the traders were saying, oh, the bonds are up 3 ticks now, it's time for stocks to rally 1.5 points. Well, that faded away around 1986, and people began to see those trends diverge, and those who had bet on the continuation of that correlation ended up losing money. Everything that looks good from the sidelines like that for a short period of time usually ends up not working. For a while, there was also an argument that the movement of oil prices determined the movement of stock prices. One of the issues I put out, I think it was about 2 years ago, showed 2 headlines from the very same newspaper. One was on Tuesday, and it said, stock market plummets as oil collapses. And the Friday's headline said, stock markets rally on declining oil prices. Obviously, the first argument was, if oil prices go down too hard, that's bad for oil stocks, which is bad for the entire market. And the next argument was, if oil goes down, that's good for the economy. There's always an argument that sounds plausible when it comes to taking an event outside the market and claiming that it is going to affect the market. Getting closer to the present, I'm sure you remember the incredible focus in 1987 on the movement of the U.S. dollar. Everybody said, this is the key. Forget oil, forget bonds, forget everything else. It's the movement of the U.S. dollar that's going to tell us where stocks are going. Well, that's begun to fade very recently, although still seemingly important to people are the trade figures. In other words, the balance of our exports to imports. People are still quite convinced that this is a big key to where the stock market is going, not necessarily that day, but certainly over the next week, month, or year. As a matter of fact, the Wall Street Journal described it as a frenzied focus on this monthly trade figure. Well, every time I see one of these contentions by someone that an outside market event is going to affect the movement of the market, I very quickly just try to decide whether that is valid. And the quickest way to make that decision is to look at a chart of the data and compare it to a chart of the stock market. Hey, if there's a perfect correlation, I'll add that to my group of indicators. But you know what? So far, I haven't found one. In fact, I think most of the time, this kind of information plays the role of a hook, something to get people thinking the wrong way when they should be thinking the other way. Let's take a look at one example. Recognize that chart? These are the monthly trade figures. Now, let's suppose that back in 1982, which is right in here, you were sitting in your office and the devil came to you all of a sudden and he said, "Psst, hey, I got something for you." He said, now look, in exchange for your soul, I'll tell you what I'm going to do.
I'm going to give you the monthly trade figures for the next 5 years. Now, I think most people are pretty reasonable. They probably wouldn't make that deal, but you might be tempted because, after all, the newspapers told you that the trade figures were the key to where stocks are going. Well, let's suppose somebody, not among this audience, of course, decides that he's going to make this bargain. He wants to make his name on Wall Street, and if he has this information, he knows he's going to get rich. So the devil comes up and reveals the figures for the next 5 years. And as you can see on that chart, not only are there deficits throughout the period, but they are increasing. And the economists have told us that trade deficits are bad. They're bad for the economy and bad for stocks. Well, of course, we all know the history now. As the trade deficit continued to widen and the hand-wringing continued about how it was going to kill the stock market, into record figures the trade deficit plummeted, and yet the stock market kept going up. Not only was it going up or just holding its own, but it was in the best bull market since the 1950s. So the trade deficit figure was a hook. Now, you may have noticed recently people reporting that the trade deficit figures have been improving. Now, people are supposed to be convinced because of that information that stocks are a buy. Is that true? Well, rather than say that there's an inverse correlation here from what people believe to be true, my answer is this kind of number is just plain irrelevant. Don't use them. They will not help you make money, and they will often help you lose it. Now, there's another aspect to the market that a lot of people feel changes things every 10 years or so, and that is an improvement or a change in technology or market mechanics. Modern communications, people cite as one reason why the stock market is different today from the way it was 20 years ago or 40 years ago or 100 years ago. Instant information by teletype, by satellite, by quote machine. Has that changed things? People say, well, the market's different today. You can't compare it with the 30s or the 50s. We have an institutional dominance now. The public is not the main owner. Institutions are. And we all know that those institutional money managers are really savvy guys, not like the public. They wouldn't make mistakes in the market. So they control it, and therefore it's different. Options came about in the 70s, and people said, oh, now this is going to affect and change the way the market behaves. The tail is going to wag the dog, and options are going to have a lot to do with where prices go. And of course, then index futures came along, and that, I think, has probably had the biggest focus as far as those people arguing that the market is different today from the way it was any time in the past. We have futures contracts on stock indexes. We have institutions getting very sophisticated using computer models to buy baskets of stocks and sell baskets of stocks. They call this program trading. It has gotten to be such a frenzy, this focus on program trading and what it may or may not have done to the market, that congressional committees are looking into the effects of program trading on the stock market. Now, I usually ask a question among people just to get a feel. I know there's a lot of argument these days about whether program trading and computerized trading and portfolio insurance have affected the movement of the market. Some people say, for instance, that the 1987 stock market crash would not have occurred if we didn't have program trading. Others say, well, maybe we would have had a decline, but it would have taken a lot longer or maybe not gone as far without those computers. So just to get a show of hands here, I'd like to ask people whether or not you think a ban on program trading would have alleviated this crash. Let's see a show of hands of those people who think it would have. All right. Are you just worried, or is this a sophisticated group? Now, you know my bias, I'm afraid. But you know what? There's an objective answer to this question anyway, because this is not a picture of 1987. That's 1929. So the answer is no. Program trading, a ban on program trading wouldn't have had any effect. They didn't have computers back then. Now, I could just as well have put a chart up here with a big label on it saying 1987 and still said there's an objective